So today we're going to take a deep dive into everybody's favorite topic, or at least it probably was their favorite topic about 5 months ago, and that's the housing market. And we've definitely seen a slowdown in or pullback in housing prices here recently. And so we want to talk about that, what's going on there, how that relates to the Fed, and then ultimately inflation. And to help me do that today, we've brought back research analyst extraordinaire Spencer. Spencer, welcome back.
Thanks, Mike. Yeah, excited to be back. Talk about some housing data with everyone.
Let's do it. So we'll start off looking at our first chart, and this is what's really gotten everybody's attention. And this is the 2-month rate of change in the S&P CoreLogic Case-Shiller U.S. National Home Price Index. And you can see right now it's falling rapidly. So Spencer, talk about what's going on here. Is this something we should be worried about? Is this anything like 2008?
Yeah, so taking a look at our chart here. So home prices, prior to the recent declines, were increasing, upwards of 3 to 4% every 2 months, based on this data here. And recently saw price declines in houses on par with the start of the great financial crisis. So if we take a look further into that data, we've got a heat map with all of our housing price data. And here we break it out by region and by metro as well. So major metropolitan areas within those regions. If you look first at the left-hand side of this chart, looking at pre-2008, the housing price declines that we saw then were much more broad-based than the house price declines that we've seen as of recent. So, June 2007, price declines were across all regions and all metros, practically, a few sticking out with positive returns, but most areas down over that time period. Versus you move over to the right-hand side of the chart, over in August, the most recent data that we've got there, it's pretty much just concentrated within that Pacific West Coast region, is where we're seeing a majority of the house declines. Areas like the Midwest that haven't had those significant didn't have as significant of a run-up in house prices, are not seeing similar declines to the West region.
Yeah. And I think that's so important right off the bat, is just right sizing the price declines. They're not broad-based like we saw in the early innings of the housing market declines in 2008. They're pretty isolated, not only by metro, but also by price tier. So that's data we don't show here. But if you really isolate the issues, we're talking about almost 10% declines in the last 2 months in San Diego, San Francisco, Seattle, Portland, Los Angeles, just in the mid and high price tiers. And that's totally different as well. In 2007, 2008, we saw some of the biggest price declines in the lower pricing tiers, because this was an all-in housing market collapse along with a financial crisis and an economic recession. And so people were losing their jobs. There's forced selling. That's not what we're seeing here. This is different. And you think about how these housing price indices are constructed. They're repeat sales methodology. And this is very important as we get into, the cause of why this is actually happening. In order to get prices to come down, you need sales. You need selling activity. And, what's been unique about this slight downturn in housing prices is activity is coming to a halt. And so we look at that on the next chart. Spencer, why don't you walk through, talk about mortgage rates and the impact that's had on the housing market and housing market activity?
Yeah, we've really seen mortgage rates increase very rapidly in recent months. So you'll see that highlighted in the dark blue line that we've got on the page here. The axis is inverted. So as you see that dark blue line going down, that's mortgage rates increasing. So if we look, over on that right-hand side of the chart, we've got that mortgage rate up against home sales and home starts as well. As we've seen mortgage rates increasing, the average 30-year fixed mortgage rate over 7%. We've similarly started seeing declines in housing sales and housing starts alongside that increase in mortgage rates that we've had.
Yeah, and we use the term freeze here quite a bit. Not only the level of mortgage rates today, but how quickly they've gotten to that point has just sort of shocked the market and frozen it in terms of, selling, starts, and then even refis, which we'll look at next. But, the point here is if you want housing prices to go up, you need people to buy. People aren't generally buying because it's very expensive. Buyers have been priced out. Not only because, although housing prices have come down, they're still very expensive. They're still up about 13% year over year. But two, who wants to pay that much in mortgage interest? A new mortgage originating at 7. But also, if you need prices to come down, you need sellers. And sellers have been priced out as well. I mean, if you're currently in a house, you currently own your home, you probably have built up a tremendous amount of equity recently as housing prices have risen. And odds are you have a long-term fixed rate mortgage somewhere in the 3% range. Why would you choose now to sell knowing that you would have to go find another house and then start a new mortgage at 7? So that's why we're calling this a freeze. It's a bit of a timeout. It's good news, bad news. Bad news is, housing prices should stop going up. So if you were a speculator or you made a short-term investment in housing or you're flipping houses, it's going to be tough for you. And that's probably what we're seeing in those few metros where home prices are coming down. Short-term investments that, haven't worked out. But, also it's very difficult to get a sustained decline in housing prices if you don't have forced selling. And we are not seeing forced selling. In 2008, when we had forced selling, it was generally from two areas. One was floating rate mortgage structures that reset higher that the borrower couldn't afford, or unemployment, people losing their jobs and being forced to sell there. And we're just not seeing that. Those floating rate products are far less popular today than they were back then. And we have the tightest labor market in history. So that's why we're calling this more of a timeout or a freeze. And, the freeze doesn't just apply to the activity, but also the lending, which is important. So if we look at refis on the next chart, Spencer, just explain what's going on here.
Yeah, very, very similar declines, very similar chart to the one that we just looked at. So again, we've got mortgage rates, 30-year mortgage rates on the inverted axis. So as mortgage rates are going down, increasing, and we've pretty much seen no activity in terms of refi going on in the housing market right now. I mean, practically zero.
Yeah, exactly. And this would be a great opportunity. If you're sitting there with equity in your home, you'd say, all right, well, I'm not going to move, right? I don't want to do that, but it would be nice for me to be able to get some of this equity out of my house and maybe make some improvements if I'm going to stay here for a while. But even if you were to pursue like a cash out refi opportunity, that would result in you taking on a new mortgage at 7%. So it's not only that people are sort of locked in place, but the equity they've built in their homes cannot be monetized as mortgage rates are this high. So it also pauses rebuilding activity. So when you freeze the housing market, what happens to GDP? The housing components of GDP are realtor commissions. There's no activity. Nobody's getting paid commissions. And then new construction and remodeling. And so that's the unique thing about a rapid rise in mortgage rates. That's why it's actually a pretty effective policy instrument, is it totally freezes everything. And it really slows down economic momentum. And, so we want to spend more time talking about mortgage rates because they are the culprit here. And no doubt it's been the Fed. This is exactly what the Fed has wanted, right? They boosted mortgage rates. So let's take a look on the next slide, talk about how mortgage rates have risen recently and why they're up so much.
Yeah, so three lines that we've got in this chart here. First, the dark blue line, again, that same 30-year mortgage rate that we were looking at on previous slides. And then in red and green, we have the 30-year treasury yield and also the federal funds rate as well. Usually what we see is that the federal funds rate, the 30-year treasury, and mortgage rates all move roughly in lockstep. You can compare something like a period of 2005, 2006. All those rates were probably within about 1% of each other. But as we've seen recently, we've seen divergence between the 30-year fixed mortgage, the federal funds rate, and the 30-year treasury yield, to where now the difference between those things is almost over 3%.
Yeah, exactly. So the Fed is consciously, rapidly raising short-term interest rates, which obviously is pushing up mortgage rates. And everybody sort of, this relationship is very well understood. But what we're seeing is if the Fed funds rate currently is at 4%, we would expect that the 30-year fixed rate mortgage national average would be somewhere in the 6s, but it's not. It's much higher than that. And so what's actually happening here is the rapid rise in mortgage rates, it's freezing the housing market, so shutting down activity in the housing market. And that lack of activity in the housing market is further pushing up mortgage rates. And how this basically happens is, if you're a bank or you're a loan originator, you originate a mortgage. Somebody packages up this pool of 30-year fixed rate mortgages, sells them to an investor as a mortgage-backed security. And I, as the investor, I'm going to buy that mortgage bond, that mortgage-backed security, but I do not expect that the life of that bond is going to be 30 years because of prepayments. Very rarely does somebody stick with the same mortgage for 30 years. People either refi because rates go lower and that prepays the mortgage, or they sell their house and that prepays the mortgage. And we just showed there is no refi activity. There is very little selling activity. And so what happens now, me as the investor, I need to expect, wow, the life of this bond, I originally thought it'd be like maybe 5 to 10 years. Now I might be holding this thing for 10, 15 years because there's no prepayment activity. And if that's the case, I'm going to demand a higher interest rate. And if I'm going to demand a higher interest rate, the originator is going to charge the borrower a higher interest rate. So the lack of activity is pushing up mortgage rates. And the other thing we're seeing, while I'm sort of on a roll here talking about the mortgage market, the other thing we're seeing is the Fed holds mortgage-backed securities. And the Fed has said they want to reduce their positions in mortgage-backed securities. Quantitative tightening. So they can roll off about $35 billion a month of mortgage-backed securities. And they're not. They're not at all. Since quantitative tightening has started, they've only reduced their mortgage-backed securities holding by $29 billion, whereas they should have reduced it by a maximum of over $120 billion. And it's because there's no prepayments. They're just holding these mortgage-backed securities. Nobody's prepaying them. And so they're not reducing the size of their balance sheet. And you could hear that, Spencer, and you might say, oh, well, that's fine. I don't mind that the Fed is going to be a presence in the mortgage market for longer. That doesn't seem like a bad thing, but it actually is. It actually is a bad thing, because if the Fed wants to reduce the size of their mortgage holdings by $35 billion in November, and let's say, for example, there were a ton of prepayments, people were selling their houses, refinancing like crazy, and $70 billion worth of those mortgages that the Fed holds got prepaid and rolled off their balance sheet. Well, they can only let $35 billion roll off. So they would have to go and buy $35 billion. And that would be extremely helpful for the mortgage market. But that's not happening either. So it's not just freezing at the sales and starts level, freezing at the refi level. It's freezing in actually the market for mortgage-backed securities. It's just an all-out housing freeze. And now that we've explained all that in probably too much detail, the question is, why do we care? Why does the Fed care about housing prices and freezing the mortgage market? And so, Spencer, please take it away and talk about why we actually care about this, because of inflation, right?
Yeah. Yeah, we know that inflation is the Fed's, number one target for this year. Stable prices, a very important part of their mandate. So one of the ways in which they can bring down, or at least keep CPI at a level which they're comfortable with, is to bring down prices for shelter. So home prices not explicitly measured within CPI, but there is a shelter bucket within CPI, and it's one of the biggest single weights in CPI, both headline and core CPI. So if you look under the services bucket there, shelter, 32.5% of the overall headline CPI bucket. And then, looking at on the most recent prints that we've had for shelter, no signs of slowing down here in terms of the readings that we've got.
Yeah, no progress whatsoever, and probably won't show progress for a little bit. But when you break down shelter, it's two things. A little bit of it is rent of primary residence, which is I rent my home. And there, you can have a renter strike. And we're starting to see that rents sort of stabilize or start to come down in some metros, because landlords just got a little too aggressive and renters are, their disposable income is getting eaten up by inflation, and they're saying, you know what, I'm just gonna add a roommate, or I'm gonna split a one bedroom. I'm gonna move further away and look for lower rents somewhere else. So that portion will probably stabilize or come down first, but the majority of the shelter bucket is owner's equivalent rent, which is basically, if I own my home, how much could I rent it for with no furnishings, no utilities? And that's directly related to housing prices. And that is why this relationship is so important. That's why the Fed wants to slow housing prices, because owner's equivalent rent is in shelter, which is the biggest component of CPI. So, Spencer, on the next slide, tell us how they're doing.
Yeah. So obviously, as you just said, the Fed can't control rents, but they are able to influence home prices, and home prices definitely influence the path of where rents will go. So here in the green line, we've got the shelter component, which includes both rents and owner's equivalent rent. And then in the purple line, we have the Case-Shiller National Home Price Index with a 12-month lead. So what we've seen is it's definitely the case that home prices slowing or have slowed. At least the rate of increase has slowed in recent months, but we haven't seen any measure of the shelter component of CPI starting to tick over yet. We may not expect it for another 12 months or so.
Yeah. Yeah. And I mean, if you sort of look at that right-hand axis there, basically what it means is in the next 12 months, shelter portion of CPI will probably be increased by about 4%, which is not great. I mean, if you're the Fed 12 months from now, you want to feel confident that core inflation is at or just slightly above your 2% target. And so that means you probably have more work to do. You don't want to crash the housing market if you're the Fed. Let's get that clear. Nobody wants that. That's not what they're trying to do. They don't need to do that. But they definitely need to freeze the housing market for at least the next 12 to 18 months in terms of prices to feel confident that they can get inflation down. And so you see that filter through to our core CPI forecast on the next slide. And you see our forecast horizon. And basically what we're looking at here is the Fed has just sort of skimmed the top off of core CPI. You look out into our forecast horizon and it shows we're going to be moving sideways until March of next year, and then finally start to come down. Still plenty of work to do. I mean, this just goes to show the Fed they know they still have more work to do. They're trying to slow housing prices to try to slow inflation. But they're going to be hiking in December, at least 50 basis points to feel good that they have inflation coming on a downwards trajectory here. They're probably going to hike at the January meeting, which is actually on February 1st, at least 25 basis points. And then they might have to do another 25 in March. So all in all, that might take us to a Fed funds rate of 5%. And you think that seems extreme, but typically, if the Fed wants to defeat inflation, they end up having to raise the Fed funds rate above core CPI. And if we're at a 5% Fed funds rate in March, that's basically right in line with our core CPI forecast year over year for March. So I want to pause there and see if we have some questions related to the housing market.
All right, Mike, first question we got here. When will it be a good time to buy a house again? Definitely a good question. A lot of implications here. Mind walking us through that?
Great question. It definitely matters. It's not just sort of a blanket answer like it would have been in 2008, which is, hey, this is a national home price and economic collapse and blah, blah, blah. It's way different. So it definitely matters where you're planning on buying the house and how you're planning on financing the purchase. Because if you don't need to take out a mortgage to buy a house, so your cost of capital is low, it might be you might have a good buying opportunity here in a few months if housing prices continue to come down in certain metros. And what's eventually going to happen here, obviously rates have risen so fast that everybody's sort of shocked and just waiting to see if they go down. And based on everything the Fed has said, mortgage rates probably aren't going to go down for the next 12 to 18 months. They're probably going to stay about where they're at and just move sideways. And so what might end up happening is everybody just sort of recalibrates their expectations. And They just rebudget and say, this is how I'm going to afford a 7% mortgage. You know, outside of those scenarios, the next great time to buy would be typically when we see housing prices go down and interest rates come down, which would be when the Fed feel that they've totally defeated inflation, and perhaps there's an economic downturn, and they're actually able to cut rates. So, yeah, tough question.
Yeah, definitely a tough time to be looking to buy a house. And yeah, definitely if you're looking for any sort of financing on that, it's going to be a tough time for you to do that. So, all right, we got another question in the queue. Awesome. What does all of this mean for somebody that does not plan to buy or sell a house? Yeah, a good question. Housing market, definitely important for the broad economy. So what are some of the implications there?
Yeah, the first implication is a slowdown in economic growth, which we're already seeing. The housing market has been the biggest negative surprise in terms of economic data since May. And so that has a knock-on effect throughout the industry. And the home as an investment is one of the greatest wealth generation opportunities we have in this country. And if you look at wealth historically and the accumulation of wealth in sort of the middle class, particularly since COVID, you know, it's really stock market returns, housing market. Actually, housing market's a little bit above the stock market. So housing market, stock market, bonds, and then, you know, value of other assets. Those are the big drivers. And so your biggest driver of your increase in wealth is basically frozen and maybe even starting to come down a little bit. And we obviously know what's happened to stocks and bonds this year. So there's the overall wealth hit, which is going to feed into sentiment. You know, the wealth effect feeds into consumer spending and consumer confidence and things like that. So there definitely are trickle-down effects throughout the economy.
Yeah, and definitely if you're also a renter as well, definitely implications is there with house price increases, even if you're not looking to buy a home. Cool. All right, our last question that we got in the queue here, what data releases are you watching over the next month?
Yeah, so I mean, we have CPI right around the corner. CPI is this week, so that'll be very important. And then, you know, pretty much every single data point that was in this slide deck, you know, we'll definitely be watching that. But, you know, no doubt inflation is going to be number one. And we're gonna be updating our inflation models this week when the new CPI release comes, and we're excited to show our updated forecast. Thank you, Spencer. I believe that's all the questions we have, and we thank you all so much for joining us. And please, if you have any questions, want to discuss any of this data in more detail, what it means for you, please do not hesitate to reach out, and we look forward to seeing you again soon.